Okay, we got stocks rising today, even though, as feared, the US launched attacks on Iran on the weekend. I say feared because it's raised concerns about a wider war in the Middle East. Iran has hit back, although commentators saying its response pretty well symbolic so far. Let's bring in Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, your thoughts? Stocks up, oil down, kind of the opposite reaction that you'd expect.
Absolutely, Andrew. It's like bizarro world. Well, the concern was at the end of the weekend that futures would be down hard and there would be a tremendous amount of uncertainty. It seems as if at least initially the response from Iran was somewhat muted and rehearsed. That bodes well, at least for the United States, that perhaps in the future, near future, they won't have to be involved. But nonetheless, that doesn't mean the Israelis are done. And one could perhaps forecast that they will be continuing their military strikes over the coming weeks in order to try to slow or topple the regime.
Have you made any change to your strategy here as a result of Washington actually getting involved?
No, we were fairly conservative going into the weekend. We're seeing a deceleration of economic trends here in the United States as well across the globe. And also you're seeing some tightening of financial conditions. By no measure is it a radical change. But we've been underweight equity risk modestly and overweight bonds.
You do say that GDP, U.S. economic reports will be incredibly noisy because of tariffs and companies rushing, for example, to order goods to get ahead of import levies.
Yeah, those imports, when you do that and you push those imports forward, what happens is it distorts the GDP numbers. So the numbers that are going to be coming out, one should perhaps be a little bit more skeptical of them. With that said, we do think GDP is decelerating. Our barometer, our economic barometer here at Washington Crossing Advisors is indicating that. So a GDP growth rate of around 1% wouldn't be a surprise to us. Nonetheless, we don't think that we're going to be in a long-lasting recession here in the United States.
But you don't think the Fed will cut till September?
Yeah, I think Powell is going to wait until after Jackson Hole. He's been indicating that they're monitoring, the economic trends, but overall financial conditions here in the United States are quite loose. Still, credit spreads are historically tight. So I think it gives him a little bit more time to sort out the tariff concerns, as well as now these issues that are happening within Israel and Iran. So there is the Fed fund futures are pointing to a quarter a point drop in September, October, and I think we're going along with those numbers.
What about defense stocks? Are they a safe buy at this stage? Well, there's never a safe buy, I know, in the markets, but are they a pretty good bet? I know they have gone up a lot.
So the defense stocks like Lockheed Martin, which we own at Washington Crossing Advisors, we've owned that for a couple of years, and we believe that overall it has a nice tailwind as defense spending is going to increase across the globe. They will get at least their share of it. So yes, we think that is appropriately valued at 15 times multiple. And then when you look at other companies like consumer staples, those more defensive stocks, they too are quite attractive.
And what about the U.S. consumer? Do you have any thoughts there? Are you happy by owning consumer discretionary stocks these days?
Yeah, well, it was quite a surprise. We saw the consumer staple companies as a watermark come out and mention that volumes after the tariff announcement went down by about 2 to 3%. That typically doesn't happen unless there's a real hard recession or a hard landing. But they've also indicated that trends have been modestly improving. That means to us that consumers are hesitant, in particular when it comes to the lower end income cohort. But again, I think the consumer has plenty of buying power. They're just worried about the headline risk that has been occurring over the last several months.
One thing you'd like to see Washington do on the tax front is come up with a system that favors investment spending more.
Yeah, well, what you need here, Andrew, here in the United States, that is a firm tax plan for business investment, not one that, changes by which party's in power, so that it generates capital spending for factories, for plants, and whatnot. Chief financial officers are looking out 20, 30 years to get a proper return on their investment. And, that type of tax plan could create some stability, create some tailwind for economic activity. Capital spending in the United States is one of the major pistons of growth for GDP growth. And the United States really needs to try to enhance that and give more clarity.